Hey everyone, welcome back to Corporate Decoder. Today, we're diving into a financial report that smells a bit like someone trying to bury bad news under a pile of fresh debt. We're talking about Chord Energy Corporation and their latest filing hints at some interesting financial maneuvering. Alright, so Chord Energy just put out this Form 8K, which is basically a quick update for investors about big things happening in the company. The main takeaway, they're trying to shuffle around some debt. This report is dated March 3rd, 2025, so it's pretty fresh off the press. Now, Chord Energy is based in Houston, Texas, and as the name suggests, they're in the energy business, specifically oil and gas. They used to be called Oasis Petroleum, but they rebranded a few years ago. It's worth noting that the energy sector is super volatile, always swinging with oil prices and global events. That volatility adds another layer to these financial moves. So what's the big deal here? Well, Chord Energy is doing two things at once. First, they're offering $750 million in new debt called senior unsecured notes. Think of these like IOUs that they promised to pay back in the year 2033. They're calling this the notes offering. At the same time, they're launching a tender offer to buy back some of their older debt, specifically $400 million worth of notes that are due in 2026. Basically, they're trying to replace older debt with newer debt that has a later due date. It's like refinancing a mortgage to get better terms, but on a much larger scale. The company also put out a press release about pricing these new notes. That press release is attached to this report. It's basically saying, hey everyone, here's the deal we're offering. Now there is a disclaimer here. This report isn't an offer to sell any new notes, nor is it requesting to buy back the old ones. There are some technicalities here. They entered into an agreement for the sale of the new notes with a bunch of companies, the main one being Wells Fargo Securities. These companies are called the initial purchasers. They are buying the new notes from Chord Energy. This agreement is called the purchase agreement. Here's where it gets interesting. These new notes, due in 2033, will have an interest rate of 6.750%. That's how much Chord Energy will have to pay per year until 2033. It's basically the cost of borrowing that $750 million. After all the fees and discounts, Chord Energy expects to get about $739.3 million from selling these new notes. So, what are they planning to do with all that cash? First, they want to use it to buy back those 2026 notes through the tender offer. If there are any 2026 notes left over after that, they plan to pay them off next June. Next, they'll use some of the money to pay down what they owe on their credit facility. This is basically a line of credit that they can borrow from when they need cash. Paying it down gives them more flexibility. It's also important to note that the deal to sell these new notes depends on some standard conditions being met, so it's not a done deal just yet. There's a bunch of legal jargon here about how these notes are being sold under special exemptions from the Securities Act. That basically means they don't have to go through all the usual registration hoops to sell them to certain qualified buyers. And of course, there's the standard cautionary note regarding forward-looking statements. This is where the company says, hey, these are our plans, but things might change. Basically, don't sue us if things don't go exactly as we predict. They point you to their annual report where they list all the things that could go wrong, like changes in oil prices, new regulations, or plain bad luck. Now let's assess Chord Energy's current moves. Are they good, bad, or just plain necessary? On the surface, this looks like a pretty standard debt refinancing. Chord Energy is trying to push out their debt payments further into the future, which gives them more breathing room. The hope is that they can generate enough cash in the coming years to comfortably pay off the new debt when it comes due. However, there are some risks to consider. First, taking on $750 million in new debt increases their overall debt load. That means they'll have to pay more in interest each year, which could squeeze their profits if oil prices drop. Second, the energy sector is notoriously unpredictable. A major economic downturn, a shift in energy policy, or even just a string of bad luck with drilling could all make it harder for Chord Energy to meet its financial obligations. Third, let's be frank, the interest rate of 6.750% is not exactly cheap. That suggests that investors see some risk in lending money to Chord Energy, which is never a good sign. It could be that Chord is the best name in a risky game or a risky player in a reasonable industry. Overall, this debt refinancing is a bit of a gamble. If Chord Energy can continue to generate strong cash flow, it could pay off handsomely. But if things go wrong, they could find themselves in a tight spot. So what's my take? Chord Energy is walking a tightrope here. They're betting that the energy market will remain favorable and that they can continue to pump out enough oil and gas to cover their debts. It's a risky bet, but one that many energy companies are making these days. Here's the bottom line. Keep an eye on oil prices, regulatory changes, and Chord Energy's cash flow. Those are the key factors that will determine whether this debt refinancing is a success or a stumble. Thanks for watching. If you found this breakdown helpful, please give it a like, leave a comment, and subscribe for more deep dives into the world of corporate filings. Until next time, stay informed.